Welcome to the bi-weekly edition of Freightonomics. I'm Zach Strickland, head of freight market intelligence with senior analyst John Paul Hampstead joining me this week. Thank you for that,
Back
JP.
at it again.
Back at it again. We got a lot to cover today. These 2-week intervals for the show, it really builds the content.
Yes. Makes it easy on us because a lot's been happening.
Well, especially in 2025. 2025 has been a little bit extra.
2024, maybe could have gone monthly.
Yeah.
2025.
Maybe this is the wrong move to go bi-weekly. I don't know. Well, I guess also I'm busy too. So that's another reason. So without further ado, today's show is going to talk largely about this import situation, what the trade policy is going to do, how it's going to unfold there, what to read, what to basically kind of dismiss. Also, we've got the American debt being downgraded. There's some, interest rates have been in the headlines for several years now, but a downgrade in the debt should have a little bit of inflationary pressure where we're really wanting that to come down. We've been really trying to get the interest rates down, and it doesn't look like that's going to happen in the near term. Also, the housing market having some slightly slower news there that we're going to cover. But that being said, you want to just kick things off with the market in two and just get the truckload and freight market in sync first?
Yeah. The truckload market's really interesting right now. When we were approaching road check week, which is kind of the middle of May, I believe it was the 13th or the 15th, if I'm not mistaken. A lot of people were anticipating like one of the harshest enforcement periods kind of in recent memory. There have been a lot of noise in the news about obviously immigration, English language proficiency, a lot of bad crashes recently. So we fully expected state DOT agencies and state troopers to hit the carriers pretty hard. And the flip side of that is we expected even more carriers than normal to take a break and pull their trucks off the road. I believe Dooner, he runs an annual survey asking drivers, like, are you going to drive, are you going to take the week off during road check week? The historical average has been 20%. And this year it was 35% said that they weren't going to drive. This is like a specific slice of like probably like owner operators and small carriers.
Well, it's mostly small carrier centric
that have the authority to make that kind of decision.
It's not your large fleets.
But what we saw in the aftermath, of course, was that the market was sensitive enough, indeed, for road check week to meaningfully tighten capacity. I think what is even more significant is that even after it was over, and the week after it was over, tender rejections stayed, kept increasing, went above 6.5%, roughly. The NTI, the National Truckload Index, which is the national average truckload spot rate inclusive of fuel. I know you have the line haul to pull up a little bit later, but the NTI has been going straight up for the past 10 days, basically.
Well, let's do the market in two, because I think this illustrates exactly what we're about. This will put the data right in front of the consumer here. So let's go ahead and get kicked off here. If you want to count me in.
Sure.
Just 3, 2, 1.
3, 2, 1.
Sure. Go. All right. Tender rejection rates for the nation, the United States. You can see the white line is the current year. You see this big spike in rejection rates, not as strong, surprisingly, as the March kind of undulations we've seen. That, of course, due to some tariff stuff, some cross-border freight coming in that really disrupted things. But again, like we said, this is not a large fleet centric event. Typically, what happens is that the large fleets get some of the fallout of the smaller operators not being available, and that drives rejection rates up. And of course, the tender data is very heavily skewed towards the larger carriers. But a little bit of a bounce here as we hit Memorial Day, so that should probably keep these rejection rates up. This is somewhat of a seasonal time of year where we do expect some elevated rejection rates. Let's go to the next chart. And this is kind of the find in all of this, is that we've had this East Coast, West Coast battle over capacity. And this chart shows you outbound tender rejection rates for California in white, the lower number, surprisingly. And then the outbound tender rejection rate for Florida, the backhaul state of the United
Which no one
States.
rejects freight coming out of.
Nobody
People
comes out.
reject freight going into, not out of. Typically.
Exactly. So tender rejection rates up this high out of Florida compared to California. Crazy. Carriers probably getting stuck on out on the West Coast. They're targeting this import freight, which of course has started to diminish. Let's go to the next chart. Here, OTVI, from a demand side perspective, demand is not moving. It's not that strong. You saw the rejection rates. They're spiking, and it's not really because of demand. It's because capacity is less available. We're at a 2-year low, 3-year low here, and it doesn't look like that's getting any better anytime soon. And last but not least, let's go to the NTIL so that we can talk about this. Look at that spike on NTIL over Road Check Week. I think the big takeaway here, JP, spot rate responsiveness, of course, a little bit more small carrier-centric market, the broker freight there, reflected in the NTIL. Certainly more reactive to Road Check Week in general. We saw it last year similarly, although this spike appears to be much stronger.
Yep.
This just tells me that this market is so much more vulnerable than it has been.
On the capacity side, for sure, this is a market that wants to heat up. It's being held back a little bit on the demand side, but any little externality that you add to the equation seems to really tighten capacity and spike those rates. So it'll be a really interesting summer. I expect the market to strengthen all the way through July 4th, honestly, from everything that I'm seeing.
Yeah, and we have this, and this is a good segue into our newsonomics, because I obviously want to cover a lot of this import behavior, because this is arguably, outside of some of these holiday periods, the next looming threat, if you will, to the stability of the domestic freight market. And it's this idea that we're going to see this import tsunami. And of course, the Gene Soroka, the head of the ports out west there in Los Angeles, Long Beach, stating they don't see the container tsunami coming. And, there is a little bit of a, agenda here that we have to acknowledge in some of this statement. But at the same time, we're really not seeing what you would expect. Like, I think when you hear tsunami, some of these hyperbolic terms, it's not necessarily a tsunami, but it is a resurgence of volume.
There's an air pocket coming, and there's also a resurgence coming. I mean, the Container Atlas bookings data, if you look at all global bookings into the U.S.,
we can pull that up.
It's definitely stronger than it was before the tariff stuff started. So it's pretty much fully recovered. Now,
there we go.
Has China to U.S. fully recovered? No. Yeah. Will it? No. And that's probably what Gene Soroka is talking about. But when you look at, for example, I believe, again, to cite Dooner, I think he brought up otri.sav, outbound tender rejections from Savannah, up like 17% right now. So
close to 20%.
The action is not on the West Coast, but that doesn't mean that the highways are being completely starved.
Well, it's that East Coast, West Coast rap battle from the 90s that we're dealing with, because a lot of that import volume that was booked way back in early April and around Liberation Day is
more juicy, less California dreaming.
Yeah, exactly. Let's pull up the booking volume index real quick here. This is showing us that booking volume, again, not the tsunami of a COVID-esque period. No. This is the last year booking volume. This index measures basically at the time of booking. So things can change before it actually leaves the port. This now has about a 10 to 12 day lead time before it actually departs the port of lading.
Right. And, that's the average lead time, but we got to keep in mind that it's really a bimodal distribution between spot and contract freight. There's some, containers that are going to be booked a few days before sailing. And there's a lot of bookings that are, weeks and months out as well. So it doesn't, the bookings is more sensitive. It's a more sensitive indicator of like shipper sentiment. The departures are sort of where the rubber hits the road, where the container hits the water, so to speak. And that's usually less volatile. But I fully expect to see a recovery in sort of departures within 2 weeks.
Yeah, the index here, of course, it's at 135 as of yesterday, May 21st. Last year at this time, it was right around 124. So a pretty decent year over year growth in booking activity, which of course we've got another 11, 12 days before that potentially translate. There's cancellations, there's upstream situations that could manifest between that point, that data point, and the IOTI. If everybody watching has familiar with the sonar data here, IOTI, of course, is the time. It's based on the time of departure.
Yeah.
That booking index has yet to manifest there. Let's pull up the Trade War Command Center here. That I think.
Oh, nice. This product release
Yeah.
was recent, but this is really my first chance to look at it.
Yeah. So, I mean, again, this is something that, Sonar has developed, basically giving you a quick entry gateway to a lot of the maritime data, but also it's connecting it to the service transportation data as well. If you look at the top left there, the ocean volume index, look at that week over week change, 3.04%. That's telling us that we're starting to see that rise in, some of these departures. Now, again, if you look at the chart on the bottom left, that's exactly what that ocean volume is measuring, is the bookings based on departure dates. So we've got this almost Lunar New Year-esque dip in container volumes leaving their ports, and we're just now starting to see this manifest, and we're seeing some uptick here, and we've got a long way to go, because if you think about the average transit time between Shanghai or anywhere in Asia to the ports of Los Angeles, Long Beach, that's about 15 to 20 days at this point in time, because there has been capacity taken offline or moved into other routes, because nobody knew whether or not we were going to see a return or any pause in tariffs.
Right. So those container bookings rejections are really high. They've taken a lot of capacity off the major Trans-Pacific lanes. And put it elsewhere.
And you look at the bottom right there. You got to squint in a little bit. I wish I could blow this up if I wanted to. But the spot rates from China to North America's west and east coast, both spiking here in the last couple of days, telling you,
there's people are clamoring for slots
that don't necessarily exist. And again, this is what happens when you have this uneven demand cycle, where people are kind of, I don't want anything, and now I need to get everything. These 90-day pauses really don't do supply chains they're not very healthy.
No, they're not. Shippers like to, keep sort of, they get the best bang for their transportation buck if their volumes are predictable and steady. And when they have to scramble to find capacity to move unexpected shipments, they get charged a premium for it, either by their intermediaries or by the carriers themselves. Yeah. So it's definitely not a fun time to be a shipper. Trying to react in real time to all of these different policy changes. I actually had a reporter from the Seattle Times kind of asking me about that, because he noticed that some the recovery in container bookings actually started before the official announcement of tariff relief on China. He was asking me so is there what's the causal relationship? How is that possible? Et cetera, et cetera. And I was like, well, you have to imagine that, all of these different verticals, they've got different amounts of inventory. They have different risk tolerances, and they have different flexibility vis-a-vis their supplier networks, right?
Yeah.
And so all of that is going to play into how, rapidly they respond to policy changes or even rumored policy changes, right?
Yeah.
It's not going to be a one-to-one linear relationship. Everyone has their own sort of, concerns and their own playbook and their own variables. And then beyond that, these industry verticals, they tend to kind of follow the leader a little bit. So if say a group of retailers decided to pause imports during the tariff chaos, they're watching their inventories run down, then all of a sudden one or two of them peel off and start ordering again. Well, the rest are going to quickly follow. And so it's not like, we lowered tariffs by X percentage, therefore there will be X more imports, therefore this number should have jumped right back up to this line. No, there's a very complex like decision calculus by all of these different parties who are watching each other. There's a bit of a herd mentality, market
Yeah.
psychology going on as well. Yeah, so it's a very interesting, um, process to sort of look at the policy changes and then watch the data and to see how that plays out.
Yeah. The next article I want to cover real quickly because I want people to understand there's a difference between future and current or previous. Long Beach sees record TUs on trade war effect. Now, may read this that aren't familiar. They can go, "Oh my gosh, there's plenty of volume coming into the ports of Los Angeles, Long Beach," and they're not wrong because this was April. So I want to pull up the customs chart here. So think about all the pull forward effort before April 2nd.
Ninth, yeah.
Basically, everybody was like, all right, we've got all these tariffs, or ninth, I guess, for China, but they basically ordered a bunch of stuff that landed in April or in early May. So if you look at this chart, I know it's noisy with the up and down, but if you look at last year, and I have a little bit of a white line average going there, and this year, you can see there's growth there, but then you see this sharp drop off starting in May. And that's what we're dealing with currently. And that's what most people are going to refer to as this air pocket of import volume. Now, the question is, how resilient are inventories over the next 30 to 60 days that shippers can kind of weather this air pocket?
What's the consumer going to
Yeah.
do?
Yeah, what's the consumer
How
going to do?
strong is the pool?
Exactly. We have all these economic concerns as well that, it's a totally different line of thinking. If you get sucked into the supply chain of things, you have to order goods to make sure that you have inventory and you don't get too low. But if the consumer doesn't show up, you're stuck with expensive inventory costs.
Yep.
And I think that's the thing we're going to have to navigate a little bit more carefully and cautiously than we did during COVID.
Yeah, 100%, because the consumer is not nearly as flush as they were during COVID.
And speaking of that, there are all sorts of stories here, and I'm going to kind of rapid fire a couple of them here. Trump tells Walmart to eat the tariffs. Well, this sounds, like something, the greedy corporation taking the all the money. But retailers like Walmart, of course, run on high volume, low margin. Walmart's going to have to they're going to have to raise prices because they're a for-profit business. You're talking about 2, 3, 4% margins on a lot of these products that they just don't have the room for. So basically they're saying, no, we're going to have to raise prices because that's just how this works. Because when you're talking about a 97% OR, there's not enough room to eat this stuff. They drive volume is where a lot of their stuff comes from. And then the next piece of this, economically speaking, so retail prices probably going to inflate, especially from the discount retail stores who operate on very low margins, high volume. The home sales, April home sales real estate, basically down. Consumers faced higher home prices and growing concern over the economy and employment, as reported by CNBC here. Home sales have been at 75% of normal or pre-pandemic activity for the past 3 years. Even with 7 million jobs added to the economy, said Lawrence Yun, NAR's.
Dropping to a new low is pretty bad because it's been operating below normal for a long time. And part of it is rising interest rates, right? When you've got a really low, say a 3-4% mortgage, it's really hard to justify, essentially, like even if you moved into the exact same house at the exact same price, your mortgage payment would go up. Like people don't like that. It sounds like an unadvantageous time to buy a house. But it's also true that housing starts in general continue to fall. So I'll remind the readers that prior to the great financial crisis, say in January 2006, the U.S. was building homes at a rate of about 2.2 million a year at that time. So the way the housing starts are reported, it's a monthly number, but it's always an annualized rate.
Right.
Now, we never recovered up to that number. The last sort of local peak was during the height of like COVID mania in April 2022, really the beginning of the end of COVID mania. We were building about 1.82 million houses a year at that time. Now it's about 1.33 million. So we're 27% off of the COVID high from 3 years ago,
Right.
right? And which was already well down from pre great financial crisis. So
Mhm.
we're building fewer and fewer houses. At the same time, we've got people coming in, we've got
Well, the inventory
normal
was up.
population growth.
Yeah, but the inventory was up even though we're building less, which I found interesting.
I see.
Yeah, and that's helping keep these prices. I think it was a 1.8% increase year over year in the average median price, I should say, of a house. So that's not keeping up with inflation
Right.
in terms of cost. So it's and cancellation rates, or how many people cancel their contracts, hit 7% of sales in April. That's up from 3 to 4%. So there is some concern here that the housing market could hit a pretty big roadblock. And again, this is a perfect segue into the next story that I want to cover here, and that's U.S. Treasury yields are basically up on Moody's downgrade. So I alluded to this earlier. Our debt got downgraded. This is not something the markets didn't already know. So financially, this was kind of something we'd already baked in, but it's still one more reason to push. I have a chart of the 10-year yield here as of 10/12, and I'm sure it's totally different now, but it was at about 4.6%. I think it hit around 4.8%. It's still down from annual highs, but this is for over the last couple of years, this is moving the opposite direction of what a lot of investors and a lot of capex and again, the 10-year mortgage or the 30-year mortgage is based off the 10-year number here. That's why I pulled it up. This isn't only going to be another headwind for the housing market.
Yeah. Yeah, and let's walk through this for a second.
Mhm.
So if the US's debt is downgraded, it becomes less desirable, right? Which means that investors don't want to buy bonds, say at par. They want a higher yield, which means they'll pay. Say it's a bond that pays $5 a year.
Mhm.
Instead of paying $100 for it, they want to pay $98 for it, right? And that's what makes that yield go
Mhm.
up, right? Because obviously $5 on $98 is more than
Right.
$5 on 100. Now, walk me through the relationship between bond yields and the interest rates because they're connected.
Yeah, they are connected. So the Treasury yields, U.S. bonds, when they have been at AAA before, that's a low risk investment. So you don't expect a high yield on a low risk. You're basically throwing it in there to beat cash.
Mhm.
So when you start to see these low risk yields increase, the cost of money, the cost of capital also increases, because that should help kind of pull down that demand. It's a supply demand curve, just like anything else. So if banks and investors and these companies with lots of capital, they go out and they buy these T-bills, that's a low risk investment. When their low risk level comes up, the stuff they're going to pass along to people like you and me who don't have the capital or riskier investments, we have to go up because
The yield's going up.
yeah, the yield's going up. So that's what's happening here. And that's why, these mortgage rates, which many people who bought around the pandemic level, we see these sharp changes in interest rates and mortgage rates. That's a very harsh climate to economically weather, because, you bought at a 2.5% mortgage, the likelihood of you going into a 7%,
No.
not very high.
No one wants to do that.
Yeah.
Now, how does that read through to other segments of the consumer economy that are perhaps more relevant for things like truckload or intermodal freight?
Yeah, the housing market is basically one of the key pieces to see a lot of this downstream freight. So if people are not buying houses, that means they don't need new furniture, they don't need new
Appliances.
stuff, finishings, as we call it, appliances, etc. So when people are buying a lot of houses or moving a lot, we see a lot of this large freight moving through the economy. And of course, that's also money that's moving through the economy. And when that slows down, on top of the fact that we do have some tariff inflation going on in a lot of these components, that's a pretty big drag that we can see on freight demand overall. It hasn't manifested yet in full. I mean, it's still pretty early in the cycle, but the housing market being kind of negative in April or a negative report in April is not great, because we're still on the front edge of a lot of this stuff. and a lot of this uncertainty. If companies see these housing reports, a lot of these big companies are watching housing markets, even if they have nothing to do with housing, because they know that, furniture companies and appliance manufacturers, that's where a lot of their growth is.
Yeah.
Mm-hmm.
It's fascinating. It's going to be really interesting to see whether the consumer actually does step up and support what we think is turning out to be a pretty healthy situation, at least on the supply side of the freight market.
Yeah. I mean, the freight market itself is a little bit more immune because we've had so much capacity leave in terms of truckload, I should say. And we continue to see record amount of exits in the truckload space. So even with the demand going down, if you're a transportation service provider, it could be worse.
Yeah.